Here's some food for thought. How much money are you going to lose during the next stock market crash? Are you prepared to lose half of your portfolio, or do you want to take action and protect your investment from mayhem? In this video, I'm going to be showing you exactly what to do in order to save your portfolio, save your investment, and potentially even profit from the market moving against you. And we're going to be starting right now. Hey, what's going on? It's Pat from Top Ticker Trades. If this is your first time here and you want to learn how to grow your wealth through investing and trading stocks in the market, make sure you start right now by subscribing and tapping that bell so you never miss a thing. I'll see you in the video. Let's go. What is going on, ladies and gentlemen? Welcome back to the channel. Welcome back to another video. Today is an extremely important topic. So we all know that the stock market has been nasty lately. It's been destroying our profits. Okay, it's been taking our profits so that we can't take them. So we got to do something about this, and I'm going to show you exactly what to do about it right now. We're going to use stock options to protect your portfolio, protect your investment, protect your money. So without any further ado, let's get started. So one way to protect your portfolio and even potentially profit during a market sell-off or crash is by using stock options. So options consist of two components, the first being call options and the second being put options. Call gives you the right but not the requirement to purchase a stock at a specific price, known as the strike price, by a specific date at the option's expiration. For this right, the call buyer will pay an amount of money called a premium, which the call seller will receive. A put is a contract giving the owner the right but not the obligation to sell or sell short a specified amount of an underlying security at a predetermined price within a specified time frame. This predetermined price that a buyer of the put option can sell at is called the strike price. Buying a call is considered to be bullish, which means you would want to buy a call if you believe that the price of an underlying asset or your stock would increase. Now, selling a call would be the exact opposite, but in order to sell a call, you have to have some type of collateral. So that could be in the form of cash, or it could be in the form of stocks. I should probably add that selling a call will require a lot of margin from your broker, as theoretically a stock can go up to infinity. And I love it when stocks go up to infinity. Has it ever happened to you too? Yeah, it happens to me all the time. I adore it. So anyhow, because a stock can theoretically keep going up until it reaches infinity, whatever that number may be, the risk is undefined and basically unlimited. So my point is that it is dangerous, so don't do it, especially not while you're first starting out. Now, we're going to discuss. Now, essentially, put options are basically the opposite of what you would expect a call option to be. So you're going to buy a put option when you're expecting that your stocks or your asset decrease in value. Now, selling a put is not like selling a call where the risk is undefined, because you know exactly what the share price is at the time of selling that put, meaning your risk is defined and you're in good shape, and I actually love doing it, okay? And you can sell cash-covered puts. We're going to get into that very soon because it's one of the best ways to get stocks a lot cheaper at a huge discount. There's only two things that can happen when you sell a put. Number one, you save money on acquiring the stock or the underlying asset. Or number two, you're going to get to keep the premium if the contract expires worthless. Which brings me to my next point. When you're a seller of options, then you're a collector of premium. If you're a buyer of options, then you're paying premium. Statistically speaking, you're going to be more successful as a seller of premium than you are a buyer of premium, which is exactly why my favorite strategies involve selling premium rather than buying it. But I do every now and then use strategies that involve buying options. All right, now that we've got some of the basics out of the way, it's time to get into the strategies that you're going to use to protect yourself. Now, I always recommend that you go do some more research on options because they're very complex and there's a lot to know, but I'm just going to show you a few basics that should be pretty decently safe for you to use. So specifically, we're going to be going over selling covered calls and selling cash covered puts. As far as leveraged ETFs go, you can hedge your position by simply buying calls or puts, whatever the case may be. But I do not recommend starting with this. I do not recommend doing this at all at this time because it's easy to lose money on those if you don't know what you're doing. And we're not going to discuss buying puts because that's just self-explanatory. The only thing I need to tell you about that is watch the premium or watch the volatility and try to buy at times that the volatility is kind of low. Otherwise, it's possible to lose money when buying any type of calls or puts, which is why I told you earlier that my favorite strategies involve selling premium because statistically, you got a much higher probability of making a profit by being a seller of options than you do by being a buyer. So I did want to put that out there. You're going to see that your success rate is much higher if you end up doing this experiment on your own. But remember that trading options is risky, so stick only to the stuff that you know. Get a paper trading account and practice. And remember, I'm always here to answer your questions. Matter of fact, if you have any questions, leave them down in the comments below, and I will try to get them all answered in either a video or I'll reply directly to your comment. But now let's get back to our strategies. So the first strategy I'm going to cover is selling covered calls. Now, a covered call is a popular options strategy used to generate income from investors who think stock prices are unlikely to rise much further in the near term. And that's how we're able to profit because you're selling them the call option. Now, let me take that back. That's how we're able to profit if you're correct. But we're also able to profit because of theta. Now, I didn't cover theta in the video, but theta is one of the options Greeks, which stands for time decay. So you're making money off of that too, unless the stock goes against you. So a covered call is constructed by holding a long position in a stock and then selling or writing call options on that same asset, representing the same size as the underlying long position. A covered call will limit the investor's potential upside profit and will also not offer much protection if the price of the stock drops. You're entitled to several rights as a stock or futures contract owner, including the right to sell the security at any time for the market price. Covered call writing sells this right to someone else in exchange for cash, meaning that the buyer of the option gets the right to own your security on or before the expiration date at a predetermined price, which we call the strike price. Now, a call option is a contract. It gives you, the buyer, the legal right, but not the obligation to buy 100 shares of the underlying stock or one futures contract at the strike price anytime on or before expiration. If the seller of the call option also owns the underlying security, the option is considered covered because he or she can deliver the instrument without purchasing it on the open market at possibly an unfavorable price. So let's talk about profiting from covered calls a little bit. The buyer pays the seller of the call option a premium, and what they're going to do is obtain the right to buy shares or contracts at a predetermined future price. The premium is a cash fee that's paid on the day the option is sold and is the seller's money to keep, and that's regardless of whether the option is exercised or not. A covered call is therefore most profitable if the stock moves up to the strike price, and it then generates profit from the long stock position while the call that was sold expires worthless, which allows the call writer to collect the entire premium from its sale. When you sell a covered call, you get paid in exchange for giving up a portion of your future upside. So for example, let's assume you buy XYZ stock for $50 per share because you believe that it will rise to $60 within this year. Now you're also willing to sell at $55 within 6 months, giving up further upside while taking a short-term profit. Well, in this scenario, selling a covered call on this position might be an attractive strategy. The stock's option chain indicates that selling a $55 6-month call option will cost the buyer a $4 per share premium. You could sell that option against your shares, which you purchased at $50, and hope to sell at $60 within a year. Writing this covered call creates an obligation to sell the shares at $55 within 6 months if the underlying price reaches that level. So you get to keep the $4 in premium plus the $55 from the share sale for the grand total of $59 for an 18% return over 6 months. On the other hand, you'll incur a $10 loss on the original position if the stock were to fall to $40. However, you get to keep the $4 premium from the sale of the call option, which lowers the total loss from $10 to $6 per share. So you see how we can mitigate risk, if the stock goes against you, but we can also make a profit if the position goes your way. So it's awesome to sell covered calls if you can do it. Selling covered call options can help offset downside risk or add to upside return, taking the cash premium in exchange for future upside beyond the strike price plus premium. And that's always going to occur during a specified period, which we refer to as, the contract period or whatever. In other words, if XYZ stock in the example closes above $59, the seller makes less money than if he or she simply held the stock. However, if the stock ends the 6-month period below $59 per share, the seller makes more money or loses less money than if the option sale hadn't taken place. So what are the risks of covered calls? Call sellers have to hold on to underlying shares or contracts, or they'll be holding naked calls, which have theoretically unlimited loss potential if the underlying security rises. Therefore, sellers need to buy back their options positions before the expiration if they want to sell shares or contracts, which increase their transaction costs while lowering net gains or increasing net losses. So the bottom line, use covered calls to decrease the cost basis or to gain income from shares or futures contracts. Like any strategy though, covered call writing has advantages and disadvantages, and if used with the right stock, covered calls can be a great way to reduce your average cost or generate income. So the next strategy that we're going to cover today is selling cash covered puts. Now, pretend you're planning on making a big purchase, but you think the item may go on sale in a week. So what would you do? Buy now? Wait and see? How long would you be willing to actually wait for that price to drop? What does the price need to be before you buy? Are you willing to risk the price going up by not buying right away? These are all questions that are applicable to investing, especially when buying stock in a company. And if you want to own a stock but don't want to buy it outright, there's a method that we can use as investors. Now, I'm sure you've guessed it correctly, and that would be selling cash covered puts. So what is a cash covered put? A cash covered put is a two-part strategy that involves selling an out-of-the-money put option while simultaneously setting aside the capital needed to purchase the underlying stock if it hits the option's strike price. The goal of this strategy is to acquire the stock at a lower price than the market's offering if the option gets assigned to you. So when and why would you use a cash covered put? Have you ever entered a limit order to buy a stock below its current trading price and pretty much find yourself waiting around for the price to drop, but the order never executes? Wouldn't it be nice if you could just make some money in the meantime? Well, with a cash covered put, you can. By selling a cash covered put, you can collect money, the premium, from the option buyer. The buyer pays this premium for the right to sell you shares of stock anytime before the expiration date at the agreed upon strike price. The premium you receive allows you to lower your overall purchase price if you get assigned the shares. But what happens if you're not assigned the shares on or before the expiration date? Well, you keep the premium, all of it. While your intention may not have been to own the stock, at least you received some incentive for waiting around for that stock to drop in price. So let's talk about the steps. Step 1 is to set aside some cash. As the put seller, there's a chance you may be assigned shares if the put buyer exercises the option. So when this happens, you're assuming ownership of the underlying stock at its strike price. Now, setting aside the cash for this transaction ahead of time allows you to prepare and have it all ready, because it's going to be pretty expensive in most cases. The reason I say this is because one put option contract equals 100 shares of the underlying stock. So what you'll need to do is multiply the strike price by 100 in order to figure out the amount that you should be setting aside. Step number 2, selling a put option. Selling a put option allows you to collect a premium from the put buyer, regardless of what happens later on in the trade. As the put seller, you always get to keep the premium that is paid up front, compared to buying a stock outright, in which you'd pay the current market price and have guaranteed ownership. Selling a put option allows you to generate some income and potentially own the stock at a lower price. Profit and risk potential. With cash covered puts, the profit potential has two components: the option trade and if the stock gets assigned. The most you can make from the option trade is the premium. If the stock is assigned and you are given ownership, your upside is potentially unlimited if the stock moves higher. But cash covered puts also have substantial risk, because if shares of the underlying stock fall below the strike price or even to zero, you will still be obligated to buy shares at the original strike price. You can see how the risk involved with a cash covered put differs from using a limit order to buy a stock.
Congratulations, ladies and gentlemen, you've made it to the end of the video. If you found this video helpful, I ask that you help this channel out by smashing that like button, as it motivates me to keep making videos just like this one every single day. If you're not a subscriber, you should consider subscribing, as I publish valuable content like this daily. You can do so from your screen right now, and if you want to check out more of my videos, you can click on the video that you'd like to see on your screen right now. Thanks for watching, and I will see you guys in the next video.